Hi everyone! In this SmartBi video, let us explain what ROI, ROMI, and ROAS mean. Acronyms are everywhere in life, and in the field of marketing, it's even worse. So today, let's focus on what these mean: ROI, ROMI, and ROAS. Here we go. ROI. ROI stands for Return on Investment. It's a measure that evaluates the return on investment relative to the initial cost. It's a key indicator for businesses that wants to know if their investments of all kinds are justified. In essence, whether or not it's worth it. ROI is expressed as a percentage, and it's calculated by subtracting the cost of the investment from the profits made, then dividing that results by the initial investment cost and multiplying that by 100. Okay, let me give you an example to help you understand. For instance, if a company spends $10,000 on an advertising campaign and made a profit of $20,000, the ROI would be 100%. Now let's talk about ROMI. ROMI stands for Return on Marketing Investment. This one is quite similar to ROI, but it's focused on the results of marketing efforts. It takes into account costs related to a marketing campaign, such as advertising expenses, content creation fees, and distribution costs. So if we talk in terms of numbers, ROMI subtracts the marketing costs from the profits generated by the campaign, then divides that results by the marketing cost and multiplies that by 100. Are you still following me? Essentially, it's important to remember that this calculation allows marketing strategists to measure the effectiveness of their actions by comparing the cost paid versus the results. Finally, there's ROAS. ROAS stands for Return on Advertising Spent. It specifically evaluates the return on investments of an advertising campaign. Unlike ROI and ROMI, ROAS specifically focuses on advertising expenses and the revenue generated from those expenses. Back to the wonderful world of mathematics. It's calculated by dividing the revenues generated by an advertising campaign by the advertising expenses. For example, if an advertising campaign generated $50,000 in revenue and the advertising expenses were $10,000, the ROAS would be 5 or 500%. So you understand that the higher the ROAS, the more profitable is your campaign. So yes, we confirm that these metrics are essentials to calculate results and to take good decisions. Just a little heads up though, these metric considers the financial aspect but doesn't consider everything, such as brand awareness, customer engagement, or even customer satisfaction. Solution? Of course I have one. Just don't forget to use other performance indicators to get a larger view of the effectiveness of your campaign. For example, in BI, especially in SmartBi, we can cross-reference multiple metrics to reach better insight possibilities. Here you go. If you enjoyed the video, like it, and don't forget, subscribe to our channel.